All right, hi guys. So welcome to the October market update. So it's been an interesting month because we finally got that correction that we were waiting for after that very strong impulsive wave. And as you know, the last month was correction month, where we had a pullback in the S&P 500, which is a very healthy correction. We need this breathing in before we can breathe out again. All right. So from the high of 3588. We fell about 11% all the way down to 3219. Okay, and it bounced and hit that 50 moving average. So I was not too sure if it was a fake out, it will come back down again. Okay, but it looked like it's just closed above the 50 moving average as of yesterday, the 29th of September. Was it the 30th? I get confused. So that's a pretty bullish sign. So as of now, again, we can't predict the future, but as of now, it looks like the market correction is over and we are back into the confirmed uptrend impulsive wave mode again, which means I expect to see the market going up to new highs. Again, there was no way to tell how deep the retracement would be. I said that this could be a possible support, but then again, it could break down and we may even find support at these lower levels. But it looks like for now, this support has held quite strongly. And if you look to the left, you can see that this was previous resistance, previous support. So that's a very significant level which managed to support the market. It also happens to be the 100 moving average on daily candles. And not only that, I look back and I realized that in 2020, the market actually opened in January at that level. So in other words, the market was coming down and it found support at the opening price of the beginning of the year, which means the market said, I'm not going down, you're not pulling me down, I'm going to end the year positive. So the market seemed to be really bullish, and again, it closed above the 50 moving average. So it looks like we're going to go higher for now, barring any other external events that could happen. So since the bottom, the market roared back 60%. We actually went as high as 11% gain for the year, right? We got 11% gain for the year, and then we lost that 11%. Okay, and now so far we are up here and we are up about 4% year to date. All right, and so again, as investors, when the market goes through a correction, it is only normal that your portfolio, your investment portfolio, will see a correction as well. We call it a drawdown, and it's very normal. No matter how good an investor you are, your portfolio cannot go up every day, every week, every month. There will be days and weeks and months it will come down. Okay, and sometimes it may go down more than the market, it may go down less than the market, right? So you find that if you have a portfolio that is diversified, you probably would go down less than the market. What was interesting about this correction was that not all stocks went down. You know, oftentimes in a correction, everything is correlated, everything goes down together. But in this case, you find that the main culprits that went down were the tech stocks. Your MAGA, right? Your Microsoft, Amazon, Google, Facebook. And the reason they went down was because they went up too much. So it was a natural profit-taking, natural pullback that was much needed, which is very, very healthy. And while they came down, other stocks actually went up during this correction. And some of them were cyclical stocks. So that really showed that this correction was a pretty healthy correction, which means the leaders kind of like, you know, after running so fast, they said we had to rest, and they let the rest of the market kind of like catch up to them. So if you take a look at there we are. So look at the actual breakdown of the S&P 500. Remember, the index is made up of 500 companies, but they don't have equal weight, right? So certain companies have a bigger market capitalization, so they have a bigger weight compared to other companies. For example, one Microsoft is equivalent to 10 of the other companies in terms of their market weight on the index. So if you take a look at the last month, which is the correction month, this is what you see, right? So it was the tech stocks that went down, but there were pockets of cyclical companies that went up, right? Semiconductors seem to be positive in the last 1 month of correction. Some consumer defensives went up. Railroads went up, okay? We had some diagnostic and research went up. Utilities went up. Basic materials went up, which are very, very cyclical, okay? So this was the last 1 month that you see here. Now, year to date, let's take a look at all the components. So year to date, you can see again, not everything is up for the year. Okay, again, like I mentioned in the last update, most of the gains in the index for the year have been driven by our pandemic-proof, recession-proof, mainly tech stocks. Right, and cyclicals, again, they went up in the last month, but for the year, many of them are still underwater. So there's a lot more recovery to be made for the more cyclical companies. Except for energy, that's really screwed. That's the black sheep of the family. I don't know when that's ever going to recover, right? Because real estate is positive as well, okay? So like I mentioned, the market went down 11% for the month. And the interesting thing is my portfolio went down 3%. Okay, so it's always a good thing where your portfolio goes down less than the market. And one reason is because my portfolio is pretty well diversified. That, besides the MAGAF stocks, the tech stocks, I have got my defensive companies, I got my cyclical companies. So as my Amazon and Facebook, Microsoft came down, my other ones came up to kind of like cushion the blow. So I had a smaller drawdown than usual, right? But having said that, if you take a look at my portfolio, by the way, this is, you can see the last 1 month, all right, down 3%, right? Now, if you look at my portfolio for the year, I'm pretty okay with it. So the S&P is up 4% for the year. My portfolio is up 25% for the year, right? I know some of the other students and even people like YY and Bang, they are like, 100% for the year, and, YY is 50% for the year, and great, right? So as you know, I'm very conservative. I'm a chicken, so I'm not so aggressive like YY, 60% a year. I just go for 20 to 30, 40% a year. I'm pretty happy, right? Beating the S&P 500. So as I mentioned earlier on, we all want to make 20, 30, 40, 50% return a year. We all want to do that. But not many people are willing to walk the psychological journey to get there. Because to get there, it's not a straight line. You have to go through those drawdowns. And I mentioned as well before that, like during the February-March crash, you can see my portfolio went from about $900,000, about $990,000 to about $680,000, right? So that was about 300 grand drawdown, which was about 25% drawdown at the time. Now the market went down 36%. So the fact that I went down 25% versus 36% is not bad, right? Less than the market. So when the market goes down, you want to go down less. When the market goes up, you want to go up more, right? So, and my other portfolio, which I also have, is slightly higher returns. I'm a bit more aggressive on this one, so up about 31% for the year so far, January to October, and way above the S&P 500. So again, the key is beating the S&P. If you can do that, you are among the best investors in the world. All right, so let's take a look at how the three indexes have performed. As we know, there has been a pretty big divergence. As usual, the QQQ, which is the NASDAQ ETF, has been outperforming the SPY and the DIA. Okay, why? Because the triple Q is the NASDAQ ETF. It contains mostly the tech companies, which are mostly pandemic-proof, COVID-proof with high growth rates. Hence, they have outperformed. And of course, like I said, in our last month correction, they also corrected more because they were overextended, which is a really healthy correction. Since the pandemic, the SPY has outperformed the DIA, but in the long run, I expect them to be pretty much the same. Why? Because the SPY contains more technology companies than the DIA. The DIA, or the Dow Jones ETF, contains more industrial and financial companies, which, as you know, take a while longer to rebound because they are more dependent on the economic recovery to rebound, right? So hence the Dow Jones is currently underperforming, which is fine for the short term. Okay, let's look at other markets. Okay, interestingly, China has been outperforming the US. Well, actually, it's not. It makes sense, right? Why? Because although the virus started in China, but China has better controlled it. There are no more serious cases anymore. I've got family and friends living in Shanghai and Shenzhen. They say the malls are packed. It's almost back to normal. So it is reflected in the market. Okay. So again, the US market is up 4% for the year. Shanghai is up 5.5%. Right? So despite this trade war and all those things, China is outperforming the US for the year. Although you can see it's really choppy, right? So you can see that was the crash from the pandemic, and then since then it has been on a tear. Okay, very strong support I drew over there. Now it went up, found resistance, came back down again. So you can see there is a strong level of resistance right now in the Shanghai market. So looks like an interesting place to add shares for Shanghai stocks, right? Why? Because it has retraced to a support level, horizontal support level, plus trending support level. So there are many ways to gain exposure to this. So my main way is buying the ASHR, which is the ASHR ETF that tracks the Shanghai Composite Index. So I'll probably add more shares in the next couple of days. Hopefully it doesn't move up too fast before I do, okay? Now, the other part of the China market, which is the Hong Kong Hang Seng, has been underperforming, mainly because of all the problems that Hong Kong is having in the short term. All right, the US has threatened or has revoked their special trading status because of the controversial security law that China has imposed on Hong Kong. All those uncertainty has caused the Hang Seng to be down 16% for the year. Okay, in the long run, I am hopeful for Hong Kong. I believe that they will, eventually bounce back. They'll recover. Things will settle down in the future. As far as, again, remember that the companies listed on the Hong Kong market, you have two kinds of companies. You have got companies where they are very exposed to the domestic Hong Kong market, like HSBC, for example. 70% of HSBC's business is from Hong Kong. You've got the property developers. Now, those will take a lot longer to recover because they depend on Hong Kong's domestic economy, which has to sort itself out, right? But in Hong Kong, in the Hong Kong market, there are many companies like JD.com and Tencent and Alibaba. Those companies, their main customers are not from Hong Kong. Their customers are from mainland China. So you can see that those are the companies that are doing really well in the Hong Kong market. Okay, so I am more bullish on those companies. And so one way to gain access to those companies would be the Hang Seng Technology Index ETF, ticker symbol 3033 ETF, which I started buying a small position, and I'm looking to add more positions on 3033, which is the ETF that tracks the Hang Seng technology company. So the Hang Seng Technology Index is also known as the NASDAQ of the East. Okay, so that's one way I'm probably going to add more shares in a month to come. Okay, Singapore. I've mentioned Singapore because number one, I'm from Singapore. Number two, I hold the 3 Singapore banks and selected REITs mainly for dividends. Now, Singapore has really done an underperformance, down 22% for the year. Okay, so what's the reason Singapore's index has been underperforming so much? Okay, reason, if you look at the 30 companies in the Singapore index, most of them are very cyclical companies. Okay, there are not many defensive companies, many cyclical companies. And unlike the US has got many of these tech companies that are recession-proof, pandemic-proof, and global. Whereas Singapore, a lot of the companies in Singapore are old economy companies that are not so much in the tech online space, right? Your banks, your shipping, your real estate, mainly the index made up of that, and that's why it's been underperforming, because that will take quite a while to rebound back. Okay, and if I'm not wrong, I think about close to 40% of the Straits Times Index, the market cap comes from the 3 Singapore banks, and that has not rebounded yet because of ultra low interest rates, because of the ongoing recession, and the recent scandal with the banks having illicit money flow has affected all the banks' perception, right? Which is good because it's an opportunity to add shares. Okay, so that's the Singapore Straits Times Index for you. Okay, now the other thing I like to talk a bit about is the VIX. So the VIX is also known as the volatility index, also known as the uncertainty or the fear index. The VIX price is affected by options. Okay, so when a lot of people buy options to hedge their portfolio, the VIX will go up. Okay, so it's correlated, right? And you can see that now. Normally, the VIX is roughly about 17 points, right? That's roughly where the VIX is most of the time historically, 17, right? But what happened was, after the pandemic, you can see the VIX went up to 85. And since then, it has stayed within a range of about 23 to about 30, right? So if you look at the VIX compared to historically, it is very high because of the uncertainty globally in the pandemic, right? But if you look at the last couple of months during this pandemic, right now the VIX is near a support level, relatively low within that high range. Does this make sense? Okay. So what I've been doing, as you know, I've been alerting you guys in the Telegram chat groups, the options group and the Ultimate Investors Playbook, is I have been buying options, call options on the VIX. Now remember that you can't actually buy the VIX because the VIX is an index. You can't buy an index. You have to buy options on the index. So I've been buying call option spreads on the index recently. Why? Okay, for a few reasons. Number one, usually when the market drops, the VIX will go up, right? So when the market drops, the VIX goes up, I will make money from my VIX options. So the profit I make kind of like offsets the temporary loss in my investment. So it's kind of like a hedge. Make sense? The second reason that I've been adding the VIX is because it is relatively low right now, and I expect the VIX to go up as we approach the US elections. Because as we approach an event like the elections, people get fearful, they get uncertain, that causes the VIX to go up. So that is kind of like a short-term bet on volatility, right? So again, if you have taken the options course, you would know how to buy call options on the VIX or buy call option spreads on the VIX. I'll talk a bit about it later on for the benefit of those of you who have learned options. If you have not, then don't worry about it. But if you do, it could be an interesting way of making some money from the VIX. But again, like all trading, there's no sure wins, there's no sure bets. You could also make a loss on the VIX, right? Always remember that. It's about risk to return. That when you're wrong, you lose less. When you're right, you make more in trading, okay? So some interesting statistics, all right? For the last 20 years, you can see what has happened during election years with regards to the VIX, okay? So 0 is the election day, which is, if I'm not wrong, the 4th of November, right? 3rd or 4th of November, right? And this chart shows you how the VIX behaves prior to the election, okay? Now, bear in mind, what you're seeing here is trading days, which means it excludes weekends and holidays. So these are trading days prior to the election. And this is fixed based on 100. It's indexed to a base of 100 90 days prior to election. Okay, so in other words, this 100 you see is not the VIX price. Okay, it's an index that they have calculated based on 90 days prior to election. They use 100 base, so you can see relatively where it is from that base. So where are we right now? As I'm making this video, it's the 1st of October today. So I calculated we are roughly 23 days to election day, 23 trading days, which means we're somewhere here. Okay, so in other words, the VIX somewhere here, and so I expect in the next few days for the VIX to spike up and hit a high roughly 7 days before the election, and then the VIX will go down again, right? So what I plan to do is I've already bought the VIX options. I may buy more later on. Let's see how it goes. And 7 days before the election, I expect the VIX to go up, and I expect to sell my VIX options to take profit, to make some good money. You know, hopefully can double my money from there. At the same time, when the VIX is at a high, I would sell options, right? So for example, I'll sell bull put spreads. I could sell bear call spreads as well, right? Basically, I will look to initiate certain option selling strategies because that's when options are expensive, and then when the VIX collapses, the options drop, I'll make a lot of money as well. But again, this is for those of you who are trading options. If you're not important, right? If you're just looking at your investment portfolio, no worries, just hang on to it. Great companies will always go up. But interesting to know, okay? I've mentioned this before, but let me talk about it again since we are coming to the US elections. You can see, regardless of who wins, okay, the market tends to rally. It tends to rally post-election. Tends to go up post-election, no matter who wins. All right. But historically, usually when the incumbent party wins, which is the current president, the market tends to go up more compared to a new guy who takes charge, because the new guy is always a bit uncertain, right? But you never know because this is not a normal president, right? But in all cases, if you add up both cases, you can see that these all cases over here, the market usually does rally towards the end of the year. You know that no one can predict the future, but if you ask me for my guess, my gut feel, I believe that Joe Biden is going to win this election. There's no way that Trump's going to win this election. There's no way I'm going to win this election. In fact, I'm so sure if Trump wins this election, I will eat this MAGA hat live on YouTube. That's right. If he wins, I'm eating this hat. If you think I'm kidding, I got my chili sauce ready. And with chili sauce, everything is edible. All right, so the market, well, that concludes this market update. May the markets be with you, and I'll see you in the next video. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.